Welcome to the deep dive. Today, we're jumping into a really interesting part of the financial world. It's called decentralized finance, or DeFi.
Mm.
It promises, well, a future maybe without the big banks, where money moves directly, automatically, sometimes really fast. But, can a truly decentralized platform get that same efficiency, that same liquidity as traditional finance without giving up its core ideas?
Yeah, and that's the big question, isn't it? There's this platform, Hyperliquid, trying to do exactly that. Their story's got innovation, sure, but also some critical debates.
Okay, so let's dig into that. At its heart, DeFi uses things like distributed ledger technology, blockchain, right, to build finance without the usual middlemen.
Exactly. It's a fundamental shift, moving power from, big institutions to these decentralized networks. And it's not small scale either. The whole DeFi market was valued at, what, $77 billion back in July 2022?
Yeah, $77 billion. That's huge growth.
It really is.
So our mission today is to take a close look at Hyperliquid. It's one platform making serious waves. We'll unpack its tech, its features, but also, the questions and controversies around it. We want to give you a clear picture, especially if you're kind of new to DeFi, but, without drowning you in jargon.
Sounds good.
Okay, let's unpack this. So maybe let's just zoom out for a sec. For anyone maybe just hearing about DeFi, what's the core idea? Because it really is a different way to think about finance.
It absolutely is. Think of DeFi like a financial system built on code, not companies. So instead of banks or brokers handling your money, you're using crypto-backed transactions.
Okay.
And these run automatically through smart contracts on a blockchain. These contracts are like self-executing deals. The rules are just written right into the code.
So people can just trade directly,
Right.
lend, borrow, that kind of thing.
Exactly. Cuts out the middleman. And advocates, they talk a lot about democratizing finance.
Right. What does that really mean in practice?
Well, it means replacing the old institutions, their fees, with public blockchains and open source software. So basically, anyone with an internet connection can jump in.
Okay.
It really shifts the power from those central players to the network itself. And a big part of how decisions happen is through DAOs, decentralized autonomous organizations.
DAOs, like a crypto co-op?
Kinda, yeah. Decision power is spread out. Stakeholders vote using crypto tokens.
Got it. So with that background, let's bring in Hyperliquid. What is this thing? How does it fit in?
Right, so Hyperliquid is what they call a next-generation decentralized exchange, or DEX. But it's not just any DEX. It's built on its own custom Layer 1 blockchain.
Layer 1, so like its own foundational network, not built on Ethereum or something else.
Exactly, like Bitcoin or Ethereum are Layer 1s. Hyperliquid built its own, specifically designed for really high-speed, low-latency perpetual futures trading.
Okay. And the story behind it, the founder.
Yeah, it's interesting. Founded by Jeff Yan, strong background in mathematics, worked at Google, even a Wall Street trading firm, Hudson River.
Oh, wow. So he knows both worlds.
Pretty much. He got into crypto around 2018, apparently intrigued by Ethereum. Then, early 2020, he started his own crypto trading and market-making firm, Chameleon Trading. So yeah, he brings deep knowledge from both sides.
And what makes Hyperliquid stand out then? What's their angle?
Their big aim is trying to merge the best bits of centralized exchanges, CeFi like speed and features, with the transparency you get from DeFi.
So efficiency and openness.
That's the goal. Their ambition is huge, to be a platform to house all of finance.
Wow. Okay.
And their launch was different too. They say they're fully self-funded, no VC money, no traditional ICO.
Really? How'd they fund it then?
They did one of the biggest airdrops ever. Gave away over $1 billion worth of their HYPE tokens to early users and the community.
$1 billion just
Yeah.
given away.
Yeah, pretty much. To bootstrap the community and align incentives from day one. Very community-first approach, they'd argue.
Okay, so if they're aiming for that CeFi speed on a decentralized platform, how? How do they pull off that performance?
It really comes down to that custom Layer 1 blockchain and their consensus mechanism. Because they built their own, they could optimize everything for trading.
Right.
They use a proprietary consensus algorithm called HyperBFT. Now, without getting lost in the weeds, just know this is their key to speed. It's apparently an improvement on systems like Tendermint Cosmos.
And the result is?
Ultra-low latency, block times as fast as 0.2 seconds, and throughput. They claim up to 100,000, maybe even 200,000 orders per second.
That's insane speed, even for traditional finance.
It really is. And their trading architecture is different too. Lots of DXs use AMMs, automated market makers.
Right, the liquidity pool model.
Yeah. Hyperliquid uses an on-chain order book, much more like what you see on the New York Stock Exchange or a big centralized crypto exchange.
An on-chain order book. Okay, for someone new, what's the real difference there? Why choose that over an AMM?
Good question. So AMMs are clever, right? You trade against this pool of tokens, price set by an algorithm. They solved early DX liquidity problems.
But they have downsides.
Sometimes, yeah. You can get high slippage, your fill price is worse than you expected, and impermanent loss for people providing the liquidity. An order book, though, it's just a list. All the buy orders, all the sell orders at different prices.
It's like a traditional market.
Exactly. It uses price time priority. Best price gets filled first, then oldest order at that price. It gives you more flexibility with order types, usually better price discovery, and liquidity can be used more efficiently.
Okay, that makes sense. So a powerful core engine. What else is in their tech ecosystem? Anything built on Hyperliquid?
Yeah, they got HyperEVM. That's an Ethereum-compatible smart contract environment.
Meaning developers can build stuff.
Right. Developers can deploy their own dApps, decentralized applications, directly onto Hyperliquid, and they can even tap into the live trading data.
Okay, that's pretty powerful.
And internally, they have key parts too. A decentralized clearinghouse manages all the user margins and positions, keeps track of everything, and a decentralized oracle system.
Oracles, they bring in real-world data, right? Like prices.
Exactly. Their validators update spot prices from major exchanges every 3 seconds. Crucial for keeping prices accurate and calculating funding rates for those perpetual futures.
All right, let's switch gears. What's it actually like using Hyperliquid? Let's talk fees. That's always a big one in crypto.
Totally. So Hyperliquid advertises 0 gas fees on trades, which is huge.
Zero gas. How?
They basically absorb that cost. The trading fees are also really low. For perpetuals, it's 0.045% if you take liquidity and only 0.015% if you make liquidity. Spot trading is 0.057% taker, 0.04% maker.
How does that compare?
It's way cheaper. Typical DEXs might be around 0.3%. Centralized exchanges often 0.1% to 0.5%. Plus, Hyperliquid offers maker rebates. Sometimes you actually get paid a tiny bit for adding liquidity.
Wow. And where do the fees they do collect actually go?
This is pretty eek. They say all protocol fees go back to the community, specifically into something called the Hyperliquidity Provider HLP Vault and an assistance fund.
So not to the company itself.
That's the claim. It reinforces that community-first idea.
And functionality. What can you actually do on there?
You can trade perpetual futures, obviously, with leverage up to 20x, sometimes even 50x, depending on the asset.
Quick reminder, leverage magnifies gains and losses, right? High risk.
Absolutely. Very important to understand. It also offers advanced order types: market, limit, stop orders, scale, TWI, plus take profit and stop loss.
Yeah.
Stuff you'd expect on a pro platform.
Sounds powerful. But is it usable for, someone less experienced? Is the interface friendly?
They've definitely tried to make it look and feel like a top-tier centralized exchange. TradingView charts orders fill almost instantly. It aims to be intuitive.
And getting started, how do you onboard?
Pretty simple. You can just log in with an email, no KYC, know your customer needed, or you can connect a standard DeFi wallet like MetaMask.
Okay. You mentioned deposits earlier. Using native Arbitrum USDC,
Okay.
why that specific one?
Ah, right. Good point. So crypto can move between blockchains using bridges. Think of it like converting currency. Sometimes bridging adds risk or complexity. Native Arbitrum USDC means it originated on the Arbitrum network. It's generally seen as having better liquidity and fewer potential bridge issues compared to USDC moved over from, say, Ethereum.
Got it. Less moving parts, potentially safer.
Exactly. And, the standard advice always applies. If you're trying any new platform, always start with a small deposit. Get comfortable, understand how it works before putting in serious money.
Definitely good advice. Now, one feature that really jumps out is their transparency. These public leaderboards showing everyone's P&L.
Yeah, it's pretty bold. Shows profit and loss, ROI, trading volume, publicly.
So you can actually see who's doing well or not so well.
Exactly. Cuts through the hype. Apparently, it even exposed a big influencer who was promoting small wins while actually being down like $600,000.
Oof. Brutal honesty.
It is. They also have these vaults. Users can deposit assets into different trading strategies run by others or by the platform itself.
Like the HLP vault you mentioned.
Right. That one uses a market-making strategy. It's shown pretty high APRs historically, though the numbers vary a bit depending on the source, maybe 5%, maybe up to 36% annualized.
But users can create their own vaults, too.
They can.
Yeah.
But that comes with significant risk. Historical data shows some user-created vaults have lost almost everything, like 99.6%.
Whoa.
Yeah. So it comes back to that core principle. Only risk what you can genuinely afford to lose,
Mm.
especially with delegated strategies or high-yield opportunities.
Okay. Now we have to get into the tricky stuff. No deep dive is complete without it. Despite the growth, Hyperliquid faces criticism. What are the main points people raise?
A big one is decentralization versus speed. Critics argue that for its performance, it maybe sacrifices some decentralization. It started with only 4 validators, the computers confirming transactions.
Only 4, that's not very decentralized.
Right. They've increased it to 16 now, but the point remains for some. Even bigger is that the platform's code is currently closed source.
Closed source. In DeFi, isn't that unusual? A red flag.
For many, yes. It's often called a big red flag. The argument is, why submit orders via a private API, not directly to a public blockchain node? Some worry it acts more like a centralized exchange behind the scenes, with maybe a higher risk of a rug pull, developers disappearing with funds.
But isn't open source kind of the whole point? For trust and verification, what's Hyperliquid's defense?
It's a key tension. The team says keeping it closed source during beta is strategic. They cite near-term risks like security exploits or competitors just copying their code before it's fully mature.
So, a temporary measure.
That's the claim. They say the compiled code is verifiable on-chain, and they're committed to open sourcing it eventually, once the core is stable and the validator set is permissionless, meaning anyone could potentially become a validator. It's a balancing act.
Okay, what else are people debating?
There's this interesting discussion about toxic flow. The founder, Jeff, has been open about this. He says Hyperliquid prioritizes order cancels over taker orders sometimes
Why would they do that?
to deliberately reduce what he calls toxic flow. Basically, trades from super high-frequency arbitrage bots that exploit tiny, fleeting price differences.
Ah, the HFTs.
Yeah. Jeff argues that filtering some of that out benefits the market makers, providing liquidity and also, quote, uninformed traders, maybe meaning regular retail users. It makes for a fairer playing field, in his view.
That's definitely not how most exchanges work. They usually want all the volume they can get.
Exactly. It's a contrarian stance. But it also leads to skepticism. Claims of no profit motive or no insiders for the core team have been questioned.
How so?
Well, especially given the HYPE token's price held up pretty well after that massive airdrop. Some sources speculate Jeff's other company, Chameleon Trading, the market maker, might have indirectly gotten a large HYPE allocation.
Ah, creating a potential loophole or conflict of interest.
That's the perception or concern raised. It prompts the question, what does true transparency look like here, especially when you have interconnected entities?
And that connects to another point people raise, the FTX comparison.
Yeah, some observers draw parallels. FTX was launched by Alameda Research, a trading firm. Hyperliquid was launched by Jeff Yan, who also founded Chameleon Trading.
So, a market maker launching an exchange. Again.
Right. Historically, that structure led to blurred lines, conflicts of interest with FTX. While there's no evidence of wrongdoing at Hyperliquid, that history makes people call for extra transparency to avoid even the perception of insiders having an unfair edge.
It's also important context, right? Hyperliquid exists within the wider DeFi world, which has its own set of challenges. Researchers point these out.
Absolutely. And those broader issues affect platforms like Hyperliquid too. First, DeFi isn't always a level playing field. Markets tend to concentrate power, even decentralized ones. Dominant platforms might emerge and charge high fees.
Like Hyperliquid's own dominance in perpetuals now.
Potentially, yeah.
Yeah.
Second, taxes. It's hard to track and enforce taxes on Sudono's blockchains. Billions in crypto taxes might go unpaid globally. Third, governance. DAOs sound democratic, but big token holders can still dominate votes, and they might need external regulation anyway.
And the big one, regulation overall.
Yeah, global regulation is patchy, uncertain. That makes innovation harder, but also leaves more room for fraud across the board.
So beyond those big picture DeFi issues, are there risks specific to Hyperliquid itself?
Sure. Like any DAX, there's smart contract risk, maybe a bug in the code, or even in the Arbitrum bridge they use for deposits. Network downtime is a risk too, especially with a newer, less battle-tested Layer 1.
Right.
Market liquidity could dry up, leading to slippage. And Oracle manipulation, someone trying to feed bad price data, is always a theoretical risk. Though Hyperliquid has put in safeguards, like limits on how far orders can be from the Oracle price, so they are thinking about these things.
Okay, so despite the challenges and debates, they're clearly building out a huge ecosystem. Let's talk about the HYPE token. What does it actually do?
Right, HYPE is the native crypto for the Hyperliquid blockchain. So kind of the fuel. You use it for transaction fees within HyperEVM, their smart contract layer.
Mm-hmm.
It's used for governance, voting on those HIP proposals we'll touch on. Validators stake HYPE to secure the network, and holding HYPE can get you trading fee discounts, up to 40%.
And the supply, how is it distributed?
Total supply is 1 billion tokens, a big chunk, over 31% from that initial airdrop, plus nearly 39% earmarked for future rewards, goes to the community. And importantly, no specific allocations for venture capital firms.
No VCs. That is unusual.
Very. It avoids that pressure or overhang from early institutional investors wanting to cash out.
And you mentioned something unique about the fees earlier, linking back to the token.
Yeah, this is a key part of its tokenomics. Around 97% of the protocol fees collected are used to automatically buy HYPE tokens on the open market and then burn them, basically remove them from circulation forever.
Buybacks and burns, why do that?
The goal is deflation. By reducing the total supply over time, each remaining HYPE token theoretically becomes scarcer and potentially more valuable. It's a direct mechanism to return value captured by the platform back to the token holders.
Okay. And beyond the main exchange, what else is in this ecosystem they're building?
It's growing fast. There's Hyperlend, a lending protocol. HyperSwap, which is an AMM-style DX, interestingly enough.
So they have both order book and AMM.
Seems so, offering different options. There's also Kinetic and Stipe for liquid staking, letting you earn staking rewards while still having access to your capital. And Hyperliquid names for user-friendly tokenized addresses like domain names.
And the community can propose new things too, through those HIPs.
Exactly. Hyperliquid improvement proposals. HIP-1 created a standard for tokens on their spot order books. HIP-2 helped with liquidity for brand new tokens. HIP-3 actually allows external teams to launch their own perpetual markets on Hyperliquid.
So they're opening it up.
Yeah, fostering more building on their platform.
All right, here's where it gets really interesting. How is Hyperliquid actually doing in the market? What do the numbers say?
The numbers are pretty staggering, honestly. As of mid-2025, Hyperliquid is just dominating the decentralized perpetuals market. We're talking roughly 70% market share.
70%? Wow.
Yeah. Daily trading volume is consistently huge, like $8 billion to $12 billion or even more.
Billion with a B.
Daily. They have over 400,000 unique users, and the total value locked, or TVL, the amount deposited in the platform, is around $1.7 billion.
How does that stack up against competitors like DYDX or others?
It significantly outpaces them. DYDX, AVO, GMX. Hyperliquid is leading by a wide margin in daily volume, TVL, market share, and users.
So that hybrid model, the speed, the low fees, it's clearly attracting a lot of traders and liquidity.
It absolutely seems to be. It shows that this specific approach, custom layer 1 on-chain order book, can seriously compete and even dominate in this niche, challenging older ideas about how DeFi trading has to work.
So reflecting on all this, Hyperliquid has really shot up, leading in scale, innovation, maybe user alignment too, by trying to blend that CeFi speed with DeFi transparency and a community focus. So what does this all mean for you listening in? We've taken a deep dive into Hyperliquid, the tech, the features, but also the really important debates around it. Centralization, transparency, its place in this fast-moving DeFi world.
Yeah, hopefully you've got a clearer picture now of how Hyperliquid works as this high-performance DX, its different approaches to fees and market structure, but also the wider context, the challenges, the opportunities in DeFi. We see even here patterns of competition, concentration emerge, but also these really innovative new models pushing forward.
DeFi promises this great democratization of finance. But as platforms like Hyperliquid push the limits, they run smack into these tough questions about building systems that are truly decentralized and transparent. So here's a thought for you. As you participate or just watch this space evolve, how can you help ensure finance's future stays open, fair, truly decentralized? Especially with this constant tension between innovation, speed, and the calls for transparency and sensible regulation. What questions will you ask about the platforms you use next? Thank you for joining us on this deep dive. Keep learning, keep exploring, and stay well informed.